5 lakhs only. And hence, you should be very cautious when you put a fixed deposit of the bank, that the bank should have a good standing, and you should not only go for a return. You should also consider that the bank has a good standing and the bank won't fail. As I stated, different banks are offering different rate of interest, but one should keep in mind the standing of the bank, reputation of the bank, and size of the bank. Because in case the bank fails, one can lose the amount deposited to the bank, because the insurance is only up to 5 lakhs of rupees. Mutual funds. Mutual funds also provides low risk investments in the form of liquid mutual fund, where the mandate given to mutual fund is that they will invest in only liquid securities, which will be having a duration up to 90 days. These have low risk. When we say low risk, is very, very low risk, but the return on that is around 4 to 5%. With increase in rate of interest, and if the interest rates gets further increased, the return on liquid mutual fund may also go up. Gilt mutual fund. In this, the mutual funds basically invest into government securities, and this generally is giving a return of around 7% or so. On a in last 10 to 15 years, it has given a 7% return. Present yield, which is available on government securities, around 7.4%, and if you take around 0.5% as the expenses of the mutual fund, you can expect a 6.9, around 7% to 7.5% return on gilt mutual funds if you invest it for long term. But in the short run, the gilt funds are subject to interest rate fluctuation, because since the underlying securities invested by mutual fund is government securities, and if the interest rate goes up, then the value of the bonds comes down, and if the interest rates comes down, the value of bond goes up. If the value of bonds goes down, then NAV available to the investor gets affected. But if a person keeps it for long term, say till the maturity of the bonds where the mutual fund has invested, say 7 years, 10 years or so, then generally he will get a return of 7.5% presently. But with expected increase of interest by RBI in the coming RBI monetary policy, we expect this yield may go up. And hence, gilt mutual fund could also be considered. The risk in this is very, very low, because finally the fund is investing into the government securities. That means all these securities are guaranteed by the government of India. However, as I said, it is subject to interest rate risk. Interest rate risk can affect your return on investments. Besides, they have other mutual debt funds where they invest into corporate loans, etc. Here, the risk is of credit worthiness of the persons to whom the mutual fund has given the loan, and hence it has a certain amount of risk which is there, and that is the reason the return in this can be 6 to 8%, or in the past it has been even 9% or 10%. Then the government of India has come out with specific schemes relating to senior citizens, where the interest rate offered by the bank is around 7.4%. However, the person who can get this interest has to have an age of more than 60%, plus there is a cap of investments of 15 lakhs rupees. That means you can at best invest up to 15 lakhs rupees in this scheme. It has a lock-in period also of 5 years, and the investor has the option to extend it for another 3 years. Then there is another Pradhan Mantri Vyay Vandana Yojana. This is implemented through LIC, in which you can invest, the senior citizen can invest up to 15 lakhs, and a monthly pension of 8,750 could be available, and the return on that is around 7%. The monthly pension is taxable. I am only covering these schemes for retired people who want to invest their money in the safe investments. So these could be good investments where their money could be fairly secured. Public Provident Fund could be another investment opportunities for younger people, where they can put money in Public Provident Fund. I will be covering about the problems and hassles, pros and cons of each asset class separately in later slides. So provident fund, again, one can put in. There's a lock-in of 15 years. That means you can, when you start putting. The other aspect of public provident fund is that every year you have to put some money into this, and if you do not put the money, the scheme lapses. And another aspect is that amount invested in public provident fund gets you a tax deduction under Section 80C of the Income Tax Act up to the limit of 1,50,000. Considering the other investments of LIC, insurance, provident fund, etc., this total limit of 1,50,000. And hence one has to look at the individual aspects of their own situation, and then only they can consider investing in public provident fund. Then there are certain schemes of post offices which are available to investors, like post office monthly scheme, where the interest is around 6.66%. You have to put every month the money in post office. You have to visit post office, get the entry made, and this has a lock-in of 5 years. This is generally available for small investors, and the total amount any investor can invest in all or different post offices is 4.5 lakhs per year. The limit is 4.5 lakhs per investor and not per post office. And that's, in other words, if a person is investing through 3 post offices, at best he can invest a total of 4.5 lakhs only under this scheme. Then post office has another scheme which is called National Savings Certificate Scheme, where the interest rate is around 6.8%. Since these are guaranteed by post offices, that is Government of India, the risk factor is very low. This also qualifies for deduction under Section 80C of the Income Tax Act 1961. Besides, government has introduced new scheme which is National Pension Scheme. NPS is basically made on the lines of international pension schemes, where a person, particularly self-employed person, can take this policy and keep on paying every year the money, and at the time of giving the money, you have the option to choose where NPS or this authority, National Pension Authority, should invest your money, whether they invest it into low risk assets, medium risk assets, or high risk assets. Based on the risk assets, your return also gets determined, and finally the NPS authority invests the money in those asset classes, and for that purpose they either use mutual funds or use LIC for the purpose of investment as their fund managers. The benefit you have is that after the tenure of the pension scheme, you can get 60% of the money in lump sum, and for 40% they will give you an annuity, which will be given on an annual basis as a pension to you at a specified amount. The other asset class could be international funds. International funds are basically mutual funds who are mainly investing into US markets and other international markets. International funds are more important for people who have large asset class, because it basically covers your currency risk. In other words, you are investing your money in dollar terms. SEBI and RBI permits mutual funds to invest up to a certain amount into international funds. So what happens is that you invest in the mutual fund in rupee. That mutual fund in turn will invest either direct shares of international market, or will invest into international mutual funds which are denominated in dollar terms or in foreign currency. Thus, if at any point of time your currency devalues to a very large extent, you may suffer losses in India, but you will gain in this for international fund, because even if the performance of the fund has been at par or similar, but you will gain the advantage of currency, because in rupee terms the return will become higher. Hence, this fund, this investment asset class is meant more for people whose assets in hand is more than 10 crores, 20 crores or so. Because then by that process they are covering even the currency risk and sovereign risk. Gold could be another asset class where one can invest. In fact, besides gold being used as a jewelry, like in the past, gold has been used as a jewelry as well as an asset class for investment. And on the tough time of the family, the gold used to come very handy, or the ornaments used to come very handy, against which either the money could be borrowed or they could be sold and money could be realized. In a 30-year basis, gold has given a return of around 5 to 6%. In the past 3 years, gold has given good return, is around 9%, and gold is a natural hedge against stock market. The general feeling is that whenever market is high, gold is low, and whenever market is low, people go to the safer asset classes, and gold is one of the safer asset class. The risk associated with this is that gold is subject to market fluctuations, and since it is subject to market fluctuations, it has its own risk. So one has to understand. But if one is investing for long term, it could be a good asset class to invest. Maybe 5 to 10% of the total corpus of investable surplus could be invested into gold. For mutual funds, there are balance funds. The balance funds means that they put part of the money in equity shares and part of the money in debt. In other words, they try to give you a balanced portfolio. That means they take you little balance risk. The return on this asset class in the past had been minus 5% to 12%. They have an exit load of 1 year in case you withdraw the money within 1 year. Balance funds normally invest 65% of the money in equity shares and up to 35% in debt or liquid assets, where the risks are low. In equity, the risks are high, but the return is also expected to high. And that is the reason they are able to provide a little better return. Then we have unit-linked insurance plan as another asset class, in which you make the investment, and in unit-linked insurance plan, again, the person who's running the scheme asks you whether you want your money in equity or in debt or in mixed, that is balanced. So that means you choose the risk profile. In other words, unit-linked insurance plan is nothing but investment in different asset classes plus buying the term insurance, so that in case a person has any fatality, then his or her dependents or nominees gets provided with the amount of capital risk of the insurance amount. And the insurance premium is very low. Finally, it comes from the investment return, which is made from the principal. Generally, ULIPs have been giving a return of around 8.5% or so. And the alternative to ULIP is that you yourself can create a term loan and can invest your money in mutual funds or in other places wherever you feel comfortable in terms of the risk profile you have. The last thing of asset class comes is equity investments. Equity investments can be made two ways. One is equity investment through mutual funds, and equity could be a direct investment where you yourself can buy direct shares in your account, for which you need to have a broker and you need to have a DP account, and the shares comes in your DP in electronic form. Our recommendations for startup investors are to go through mutual funds, because mutual funds invest in equity, but that is managed by professionals who have very good understanding of market, have very good financial education and understanding of investor behavior. And hence, initially, it is always advisable to start with mutual funds investment in equity, and one can go for direct investment in equity once he feels adequately informed and he has experience in investing. With this, I will take a small break, and we'll come back again after the small break. Thank you very much.
क्रिटिकल है बट वी आर ट्राइंग।
ये सब हुआ कैसे?
एक फोन आया था राजेश के पास। उसने कहा कि उनकी 1 करोड़ की लॉटरी निकली है। और उसके लिए उसने बैंक डिटेल्स मांगी। राजेश ने सारी डिटेल्स दे दी। 1 घंटे के अंदर ही उनके बैंक अकाउंट से सारा पैसा साफ हो गया और वो यहाँ आ गए। हार्ट अटैक आया है।
देखा आपने, आपकी जरा सी असावधानी क्या कर सकती है। डिजिटल फ्रॉड करने वालों से सावधान रहें। अपनी बैंक डिटेल्स, अपना डेबिट या क्रेडिट कार्ड नंबर, एक्सपायरी डेट, सीवीवी, ओटीपी, पिन